it is very rare to see a hammer pattern form on the index, and then even rarer for the index to close below the hammer pattern. The chart in front of me is that of the Nifty Small Cap 250 index, and as we can see here, the candlestick mark here is the hammer that was formed. You may recollect that a few days ago I had presented a video in which I spoke about the gravestone doji and the possibility that it might hold the low. The aspect that we didn't cover was the candlestick that was formed on the small cap index, and that is the hammer pattern. So this is the hammer candlestick, and as we know that it is one of the very few candlesticks which is a single reversal pattern. That is, such a candlestick typically needs a very small confirmation because the high is almost non-existent. So I'll just complete this text here. So a hammer candlestick is typically a candlestick in which the distance between the open and the close, let's say here in this case, if you focus on this part of the screen, you will notice that the open and the high are pretty much the same. There's a distance of just 13 points at a base level of 15,000, which should be a very small number in percentage terms. And we can see that the opening value of 15,115 and the closing value of 15,050 has a distance of just 65 points. However, the distance from the closing value of 15,050 and the low of 14,600 has a distance of almost 450 points. In other words, we can see that the body of the candlestick and the wick of the candlestick exceed a 3:1 ratio, and in the process form what is known as a hammer candlestick. A hammer candlestick, as mentioned earlier, is a single candlestick pattern which generally signifies a halt in the direction of the prevalent trend. A reversal candlestick forms the basis of a potential reversal, but it does not in itself indicate that the reversal will be sharp. That is, it does not give sufficient information on the nature of the reversal. But what it does is it does give an idea that the price should typically stop. For example, we will see the occurrence of a hammer candlestick here in the past. Now, this low that the candlestick formed supported the market for a significant period of time. And now, as we trade even lower, we are approaching this low, which is not exactly a hammer candle, but as we remember, this is the event low, the general elections, the result event low. And we can see how there is a inside day candlestick followed by confirmation, etc. And the price did rally upwards. However, the low that was formed at this stage held itself for a very long time. The same ideally should have, or in theory, is reasonable to expect from this particular low as well. But unfortunately, just 2 days later, the market has closed below this low, which means that this pattern is no longer applicable. And therefore, we have to simply wait for the market to give a confirmation of some other kind before entering a long position. The question is, why should we enter the long position? And as has been discussed before, if we look at this particular security on the monthly time frame, we will see that even though the index has corrected almost 22% from its high, ignore this wick that is formed on this chart. This is sort of like a flash low which didn't really take place in the market but has been registered in the price action. So just ignore the wick for now and just assume that the blue line, which is the closing, is pretty reflective of the low. You will notice that this is of course an index which has formed a higher top and is currently retracing. The structure of this index is no doubt bullish, and we are looking for tactical confirmations on smaller time frames in order to time an entry. One such confirmation or one such pattern, that was the hammer candlestick, was formed a couple of days ago, but unfortunately the market broke its low. And this has happened in the Nifty 250 index, the small cap index. We will now just quickly Given that we have the perspective of the broader market, we will have a look at the other markets in order to assess if uh, if the fall is more likely to continue. The reason is that all markets at some level are reasonably correlated, and we are currently in the unfolding of an event in which the Indian Prime Minister will return from his visit from France and US. And it is reasonably safe to assume that as the meeting has conducted and the press conferences are made, that a potential for more favorable trade and commerce between the two nations, including defense, is likely, which should fundamentally be okay. I mean, it's much better than many other scenarios. For example, in the reciprocal tax scheme that Donald Trump has proposed, India is not exclusively there on the list yet. And also, if you notice that India is one of the very few countries to which the US is actually selling the F 35s, the other examples being Japan, where they actually manufacture the F 35. And of course, if you remember that they cancelled this deal with Turkey after Turkey bought the S 400 defense system from Russia. India is one of the very few countries which has the S 400 defense system from Russia, and yet the US is encouraging India to purchase the F 35 aircraft. By itself, it looks like it's a deal in isolation where a country is trying to make a sale of one of its products to another country. But actually, what it really represents is that in addition to the money that is involved in the entire process, the message that it sends out is that one of the major economies in the world consider this developing economy a reliable enough partner to outsource, let's say, weapons of mass destruction. The F 35 inclusion, if at all it happens, these deals typically take a decade to formulate, as you would remember, not just in Rafale or Bofors, but just generally the whole B2B process of procuring something so state of the art could take many, many years till it realizes in the Indian aircraft, in the Indian fleet. But still, the message that it sends out is one of a lot of strength. And if India shows interest in purchasing defense equipment from the US, US becomes even more disinterested in countries like, say, Pakistan and Bangladesh, etc. So let's just, with that in mind, and the fact that we have just a key recap on some major fundamentals. First of all, we had a very favorable budget. In my opinion, it's a very good budget. Secondly, we had a rate cut after almost half a decade. I think third major development would be the export of Indian defense equipment. I would not say export, I will just say potential, because like India would take maybe half a decade to decide on the F 35, so will France take sufficient time to consider the Indian defense equipment that it intends to it intends to, the Pinaka missile, the rocket launcher system that it intends to purchase. So potential Indian defense export, further the potential of import of the F 35, which is the state of the art aircraft, a very stealthy aircraft. I mean, a lot of material and literature is available on this particular subject. So broadly speaking, we had this. We obviously had Trump coming into the process on 20th of Jan. The budget on the 1st of Feb. The rate cut that was announced a week later, and the potential of trade in defense segment. And also, if you notice that they would have mentioned the IMEC corridor, which is a huge impetus for cargo and shipping segment. So in general, this looks like a very favorable, fundamentally a very favorable time to actually be building long positions in the market. Unfortunately, technically we are not seeing the market stop at this point, and we will just have a look at the other markets, the broader markets in India and global markets, to see if there is any potential of support in the near future. So I'll just continue with Nifty Mid Cap 100. Now that we have just discussed the Nifty Small Cap 250, and you will recollect that this is the gravestone doji. The market today did create a new low, but it has not closed below this low, so it's not optimal, because after the gravestone doji we had another doji, and today the sell-off is not the most optimal side. We would have preferred perhaps a stronger closing, maybe a hammer to say that this particular low of around 49,150 is going to be will be held, because it's unusual for the market to typically create new lows after a pin bar is formed, unless there is some serious fundamental justification. I don't see that kind of fundamental threat at this point. I do not know. So therefore we'll have to wait for confirmation on this market. Let's have a look at the Nifty 50. So in Nifty also formed a doji on the day that the mid cap formed a gravestone doji and the small cap formed a hammer pattern. Nifty also has created a new low relative to day before yesterday, but it is pretty safe to say that this is looking like a double bottom. So once again we need a good green candlestick to make the case that we are looking at buying potential bottoms. I mean, a very aggressive trader could consider 23,250, but a more reasonable value to enter could be 23,400, which seems like a reasonable value to consider going long below the lows, say 22,750 and so on. So Nifty is so as we can see that the Indian small, mid and the large cap are all under pressure, with the small cap index being under significant pressure, and the correction at the index level is somewhere between 15 to 20%. For the new investors and for students who are not very heavily invested in the market, a 20% correction at the index does not sound like that much on the surface, but you must understand that stocks have typically a two times the beta of an index. So it will be reasonably safe to assume that people who have invested significant money could even be seeing 30 to 40% erosion, maybe 40 or 45% erosion from the highest level that their portfolio had reached perhaps in October. And what it does is it creates a spillover effect in which the individuals, once they start losing money in the market, cut down on certain investments such as real estate, or start delaying payments. And so it will be interesting to see the Nifty Realty Index, because that index has taken a real hammering in quite some time. In fact, it will be interesting to just see the trend. So the trend, of course, is, I mean, this index has given a breakout for the first time. So I'll just draw the horizontal line here so you can clearly see what I'm referring to. I'll just darken it right here. So what we'll see is that the high that the index created in 2010, which is the Euro crisis, if you remember, was tested only in 2021, just before the COVID correction, and was decisively taken out only in 23 August, which means we are looking at just about a year or so, a little over 15 months. And within that much time, the index moved from, say, the near 550 levels to an approx 1100 levels, which means the index doubled within 1.5 years. So of course many would assume that, means you would often see that a lot of individuals would say, had you bought here, for example, had you bought here, you would have made 5x or 3x the amount of money. But what they ignore is that this index was exactly here for almost 13 years. So you could have bought there and held for 13 years, and then if the index doubled, you would see that your returns are pretty muted, which basically is the story of the realty index. The unusual thing about the realty index in relation to others is basically the extent of the correction you may note that the high is approximately 1150, and currently it is trading at approximately 850. That's a 300 point correction, a near 30%, or not a 30 but more like 26-27% correction at the index level. The extent of pain for the investors in this segment could be quite unimaginable. I mean, if someone has invested a lot of money on Shobha, DLF, Prestige, Brigade, Godrej Properties, etc., they would be seeing some trouble. And on the daily time frames, you would hope that there was some reversal, but still there is absolutely no sign. It's not even given a very strong bullish reversal candle on the daily. We do have on the upside, I mean, just when we look, this is a weak morning star. The reason why it is a weak morning star is because even though there is a gap down and a gap up, the extent is not too much, not as much as you would like. And so this is good. I mean, usually if there is a bullish reversal candle at a particular price point, it is at that price point that multiple bullish reversal candles start forming. And on the downside, we can see that there is this gap, and on this gap we can see this bearish engulfing candle, which is pretty much the range top. So it becomes a positional trader can very easily wait for this index to take out this high. I mean, one could even enter sooner, but let's say for example a more aggressive trader enters at 869, 870 index level. They run into the risk that the price could, for a sustained period of time, do something like this right here. They run into this risk that the price might not break out from the range for quite some time. And because there is this risk that the price might not break out of the range for an extended duration of time, the idea is that the individual will place a buy order above the high, which means above this particular resistance here, so that whenever the price breaks out, maybe give it a couple of weeks or months, they are dragged into the position. Of course, when this would happen, the hypothesis based on current information would be that this is the low. So logically, at that point in time, one would want to enter at say 970 odd levels with a stop loss of, let's say, 815, 820 odd levels, which is around 150 points or close to 20% SL at the index level, which will contribute to about 30-35% in SL at the individual stock level. But this is all at that time. But for now, we are not seeing much respite, but we can always be hopeful, because the market, even though has created a new low, it is not really very far away from where it was on, say, the 27th of Jan, which is just a couple of weeks ago. In other words, that even though yes, sellers are making money, but only those sellers are making money who are selling the rise. Because if you compare low to low, there really isn't. So say for example, if you look at this here, and if you look at this, that's the extreme point here, the distance is maybe not even 2 or 3%. So it's obviously painful every time the market creates a new low. There is a fear that it could extend indefinitely, and that fear is reasonable. It is reasonable to have that fear. One should have fear so that they increase their possibilities of survival. Still, I mean, objectively speaking, given that this index has corrected 30 odd percent, a 2-3% trading range would be something that the index would normally move in a day in such an environment, this particular index. So this is mostly on the domestic front. We can just have a look at a few foreign indexes such as the S&P 500, and this doesn't require much to think. This is a clearly much stronger index. It's a mirror image of ours at the moment. Would you like to buy at the resistance? I'm not sure, but it is much safer and a much more happier place to be compared to ours. We could look at some others. Say for example, we could look at the UK 100 as a potential index, and the FTSE 100 as they call it, and this is also a much stronger index. Of course, we are seeing a sort of a bearish candlestick and its confirmation here, but I wouldn't dig too deep into this, because the one thing that is unique about the UK market is that it is first of all trading at its all-time high, and even though the data here is restricted, one could, if I just select a tool like this here, a rectangle, and I extend this from here for quite some time, say for example till here, you will see that the market, and I will take another tool here and extend this one here. So why I'm highlighting these two price points is, so this is more appropriate, is that this range that we see here in the blue color, the first range, so I'll just make this one, let's say, um, lighter shade, and this one a slightly more darker shade, which is the current one. So this range that we are saying, that is a level of say 6300 on an average. So the high of this is say 7000, the low of this is approximately 6300, so I'll say maybe 6500 at the index level. I'll just draw this line here, was in question all the way from 2007 till maybe 2021, which is the COVID recovery. So for 14 years, the index pretty much averaged on the higher end, I'm saying, average on the higher end, I'd say 63, 6500. If you take a holistic average, 5500 is a more closer one. But the index for a good 2 decades almost has pretty much traded around this level, of 15 years approximately, has traded around this level. And this level was even tested in 2022-23. This is at the time of Russia-Ukraine. And we can see this high that the index formed in 2018, which was tested after 5 years. It was tested after 5 years. And if we zoom in closer, at this point here, we can see there's a clear close above life high at a significant value. And then after this close, there has been a consolidation for roughly 9 months of consolidation, and then there is this fresh breakout. So given that this is what is happening on the monthly, I would not ignore what is going on in the daily, but I would see it in the perspective that we are looking at an index which has given multi-year kind of a break after a very, very long time. So something must be looking up for the Britain economy, because it's after a very long time that they have given a new high. Let's have a look at France. So it's obviously trading in a range, but a much better place to be than where we are at. So good for them. We can have a look at Germany. Wow, this is so strong. This is extremely strong. This is a complete money index. This has completely broken out. Now the thing about Germans is that they are one of the largest exporters in the world. They have a huge trade surplus, and despite the energy inflation, if they are managing to create such highs, it looks like German automaking industry is poised for a boom. Definitely it'll be interesting to have a look at charts of BMW, Mercedes and other companies like that, because this is very strong actually, and we all know how important the auto industry is for this particular economy. Let's have a look at South Korea. So this is KOSPI. It's obviously monthlies, so it's a happier place to be compared to us. It's given a range break, and when a security gives a range break, sky is the limit. And the interesting thing is, it's very rare to see this actually. Just if I zoom here, not very often do I see this, but this is largely happening because of the low liquidity on this. This is an abandoned baby candle. This is an abandoned baby candlestick. I forgot the spelling of abandoned perhaps, but abandoned baby candle pattern. This is like really rare. This is something like an evening star, but the only difference is that the gap up high and low is never really tested in the price action, and when that happens, that is a very bearish or a very, very bullish sign. It's very rare to see it happen, so yeah, so this is one of the reasons why it makes sense to just glance at many charts just to gain exposure on what is happening in general. Let's have a look at China. I think China is a Shanghai composite. So this is just look at this. I mean, it looks like the every place in the world seems to be happier than where we are in terms of stock market. So obviously from 2700 to nearly 3700 in a matter of a few days, and a huge amount of consolidation after that. It looks like this is a usual structure of a very ranging chart. For example, this is the structure of the Chinese economy. So we can see, obviously we know that the markets capture the economy provided they are allowed to freely trade. One of the restrictions with China is that they they control a lot of trading activity that is happening, and China looks like it is just it looks like it's in a very weak uptrend. So this is a pattern that is ongoing for a very long time. I don't even the duration of the pattern is so much that it is difficult to make it reliable. But obviously, a break at 4,000 levels would be quite historic for China. The safer bet is that it is not going to break that. That's largely because one of the rules of a pattern. So instead of having this ray from here, I'll just reduce the length. So, let's say this is definitely a point of support. This right here. So I'm looking at I'm making this at closing levels, and of course here. So one of the critical aspects of a pattern is that it must break before 2/3 of its length on the horizontal ellipses. This has exceeded that, which means that it is likely to break, but the break will be a fake one, and it will revert back into the range, and at which point we'll have to check for a potential of a new top after that. So yes, so it's interesting in the sense that this is looking like the kind of market that typically if I were trading I would just avoid it, because it's a very trappy it's quite trappy to see such price action form. Anyway, so when we come back on the daily, we can obviously see this very bullish price action, and anyone who would be trading on the long side, the unfortunate thing for them is where do they keep the SL. If they keep the previous pivotal low as the SL, this also happens to be an area of so strong support. There's a clear breakaway gap. We can see this a long correction. Just look at this from May all the way to September, from nearly 3100 to 2700. That is a 16% correction even on this index, and then the bounce. And it is because of the potential of the market to do this that forces traders to try to time the long side of our markets. Anyways, I hope this video was useful. The intention was to go through a few charts and to discuss theory as we see them happening in front of us on a reasonable price, on reasonable time frames. I wish you all the best for the remaining trading week.